We've heard about the brains of AI, the chips and the software, but the conversation is shifting toward the body, the massive infrastructure and power required to keep those brains alive. Joining us to break down the physical side of AI is Matt Sallee, head of investments at Tortoise Capital. Matt, thanks so much for being here at the desk.
Thanks for having me, Caroline.
So as we think about portfolio construction in 2026, do we need both brains and body? We're talking about the body, obviously, but do we need both in our portfolios?
I think we need both. Most people have the brains already. If you own S&P 500, you're going to own plenty of NVIDIA or other chip makers. That's why we differentiate with our fund, and we're more focused on the body, as you describe it, which is funny. That's how we talk about it as well. This is the physical infrastructure that's required for AI to be provided. So if you think about the servers, the racks, the big thing obviously is electricity. That's the gating factor. Everybody used to think that it did used to be chips. Now it's all about electricity, and then things like cooling and the other physical infrastructure. So that's really where we're focused. And when you hear about hyperscalers spending $400 billion, our portfolio are the companies that they're spending that money with.
Okay, so talk to us about what some of those companies actually are.
So Modine Manufacturing, as an example, this is funny. It's a 100-plus-year-old company. They used to make car radiators. They've obviously pivoted their business a lot over the years. Now they're focused on liquid cooling. That's also one of the big constraints. Is that these chips obviously run really hot. They use a lot of electricity, so that requires a lot of cooling. You can do direct air cooling. There's a number of different types of cooling, but liquid is becoming the preferred method, and that's what Modine does, as an example.
And you can get exposure to Modine through your Tortoise AI Infrastructure Energy Fund. What are some of your other biggest holdings?
Yeah, so at TCAI, that's what we're focused on, is the infrastructure. Biggest holdings are companies like Vertiv, another liquid cooling name. Arista Networks is a networking, as the name would suggest. Really, think about it as kind of the traffic cops of getting data around. Mm-hmm. Dell Technologies is another one where, obviously have pivoted. I always historically thought of them as a PC maker. Now they're making AI server racks. And again, this is a company that still trades at a wildly discounted valuation, even though it had a good run in 2025. And so as they pivot their business, that we expect them to continue to re-rate. So those are some examples. We also have big exposure to some of the independent power producers. So I talked about electricity. Electricity is the gating factor, and these companies are procuring energy as quickly as possible. One example is Vistra Energy. They just made a $4 billion acquisition yesterday of gas plants, 5 gigawatts, which, to put that in perspective, that's enough to power New York City on an average day. So they got it for a really good price. It's located in the PJM market, which is the Northeast, as well as the ERCOT market, which is Texas. Those are the two arguably most attractive markets in the country. And so it's really all about speed to market, and that's what they're doing, is acquiring any assets they can, because it takes a while to build a new power plant.
It's interesting because I saw in your notes that you called electricity the new oil in an AI-driven economy. But what does that actually mean for investors?
So I can't take credit for that. I love it, but my fellow portfolio manager coined that phrase. But so what it means is electricity is really the future of energy. So oil will continue to be an important part of the global energy mix, but it will lose market share in our belief. And what will certainly gain market share, and has been, is electricity. So if you look at electricity in our country, the last 2 decades has really been stagnant in terms of demand. We're at the precipice of that really changing and growing at a significant clip for electricity. Mm-hmm. I mean, we're talking 3.5%, 4%, which, and expected to double by 2050. So the need for electricity is huge. Spending on electricity last year, capital spending, it blew my mind. I'm an energy nerd, though.
Not an energy nerd, but go ahead.
Spending globally on electricity was greater than capital spending on oil, which is kind of wild to think about. And that's where the bulk of the CapEx dollars we think are going to be spent going forward.
As we think about the brains versus the body, you mentioned that investors probably already have exposure to the brains because of the S&P 500. But given the fact that the S&P is so tech heavy, would you say that investors are underestimating the energy and infrastructure opportunity?
100%. That's one of our biggest, call it a complaint, but Energy is 3% of the S&P. It's, most people have an allocation between 0 and 5%. If you look at the earnings weight of energy in the S&P, it's over 10%. If you look at the weighting of energy in the economy, like just how important it is to our economy, it's over 15% of GDP. So energy is really underrepresented in most portfolios and underappreciated, and it's one part of the market that actually trades at a pretty reasonable valuation, discounted valuation, versus most of the other market is at all-time highs.
So you can't get exposure through a fund tracking just the S&P 500. Why get it through a thematic ETF like yours versus just stock picking some of those names that you mentioned?
So we have a portfolio of about 50 names, and it really takes a balance of what we break it down into energy infrastructure, digital infrastructure, and the data centers themselves. So it's really a packaging of all parts that have to happen to provide AI, really outside of the hyperscalers. So these are the companies benefiting from the hyperscalers. And what we're doing, what makes us unique is it's actively managed. And we're looking for, kind of diamonds in the rough, if you will. So as an example, one set of companies that we've invested in and have done quite well are the Bitcoin miners. And you're thinking, well, how do Bitcoin miners fit in? Well, they procured power to make Bitcoin several years ago, and what they're doing is effectively what these are data centers that were producing Bitcoin. What they're doing is they have to beef them up, and add redundancy, but then they're able to provide high performance compute services or hosting services, and they're then under long-term contracts with fixed rates rather than being exposed to Bitcoin prices and have massive volatility in their earnings. Well, what's that lead to? A significant re-rating, a higher cap multiple. So, finding diamonds in the rough like that is, I think, some of our special sauce and why our fund is unique.
Who is the bigger winner in the AI power race? Is it nuclear energy? Is it natural gas?
Natural gas is going to be the big winner, simply because, and we're big fans of both. Natural gas is the big winner because we have tons of it, it's really cheap, and that's the quickest way to get to market in terms of new power. Now, nuclear is also going to play a role. There's 3 different reactors that have been mothballed that are being brought back to service, and those will have a massive impact. They're big, one of them, as an example, is 2 gigawatt facility, which, again, going back to, like I said, average New York, consumption's about 5 gigawatts. So these are big plants. So we'll bring those 3 back. That can happen relatively quickly. In terms of building a new nuclear plant, we'll see. Fingers crossed.
It'll take some time, right?
It will take a lot of time. The last one was built was in Georgia, and it was 10 years delayed and about 2 times over budget. So I think the regulatory environment's gotten easier, but it's a risky proposition to build new large-scale nuclear. A lot of companies are focused very hard on small modular reactors, and that's something, again, it's probably 10 years, it's at least 5 years out, if not 10. The technology works, it's a matter of making it economical. And we're believers, we just think it's gonna be a little while. We actually created a new ETF, the Tortoise Nuclear Renaissance Fund, TNUK, TNUK, that invests in nuclear power plants, large scale and small scale, as well as uranium enrichment, kind of the whole value chain, which it's become a national security imperative to reshore nuclear, the nuclear supply chain, which we really have relied on foreign and sometimes not real friendly countries. So as we bring that back, reshore the supply chain, we see some pretty good opportunities there too within nuclear.
You mentioned the regulatory landscape getting a bit easier. So just to wrap things up, I'm curious, are there things like regulation, constraints, supply constraints, tech issues that could kind of derail the AI energy and infrastructure thesis, if you will?
I think the biggest thing, the hyperscalers are super well funded. They produce tons of free cash flow. They have A to AAA credit ratings, so we're not real worried about them having the wherewithal to spend, and I think they're going to spend. The question is adoption. I think that's a pretty modest risk in terms of, I don't know about you, but pick your service that you like. I use AI, on a daily basis now, whereas even just a year ago, it was pretty rare that I would use it. And I think corporations or businesses are just now adopting and realizing the efficiencies that can be gained, and potentially hires avoided, or just make your business run better. I think we're in the very early stages of that. The other thing that could derail it is, as I talked about, electricity is the gating factor, and it's not like you can throw up a power plant overnight. So, that's a challenge. And then, just in terms of permitting, the biggest thing that we have seen some significant improvement in terms of building pipelines. So there's an enormous amount of natural gas, and it's next to free in the Marcellus Shale in the Northeast. And then, Northeast really needs more natural gas. So, and specifically to produce electricity. So we've seen a couple pipelines that Williams companies had proposed a number of years ago that they kind of gave up on because they couldn't get the permits. Those pipelines are now moving forward. So significant improvement, something really concrete that we can point to in terms of permitting improvement that will make a real difference in reliability and allowing AI too.
Okay, we'll leave it there. Thanks so much for shedding some light on this space. Really appreciate it.
Thanks, Caroline.
That's Matt Sallee of Tortoise Capital.